Have you ever looked at silver and felt like the world had forgotten about it? That's exactly where some of the biggest opportunities in precious metals hide. When silver was trading around $20 an ounce, nearly everyone hated it. People mocked it, ignored it, and even wished they had nothing to do with it. But as a gold and silver analyst, I've learned something crucial. The best time to invest is when others are full of doubt and hate. At that time, silver wasn't just undervalued, it was unloved. And when you understand market psychology, that's exactly the kind of environment where massive gains are waiting to happen. You see, investing isn't just about picking a popular asset. It's about understanding why the market is wrong and positioning yourself for the inevitable shift. Take a moment to think about silver at $75. On the surface, it seems high. But if you step back and look at the fundamentals, it's a very different story. The top silver producers were trading as if silver was still $45. That means even if the price of silver stayed flat, these companies could still rise because their value hadn't yet caught up to the market price. That's the kind of hidden leverage smart investors exploit. Here's where the psychology gets interesting. When silver first started surging, the public's excitement was euphoric. People were thrilled by the sudden gains, and naturally, the market responded. But once the hype failed to deliver in the short term, the same audience turned hostile. Silver went from being the star of the show to something people hated. And in investing, that's when opportunities get real. When an asset is hated and forgotten, that's when a sharp upside often begins. Silver isn't like gold. Gold has always been seen as a store of value, a safety net during times of monetary instability. It's steady, predictable, and widely recognized as a hedge against inflation and currency debasement. Silver, on the other hand, behaves differently. It is volatile, it moves in waves, and it often lags behind gold before outpacing it during bull markets. That lag is exactly what creates huge profit potential for disciplined investors. At Gold Silver Scope, we focus on reading these signals clearly. We don't chase hype. Instead, we analyze why an asset is undervalued, how the market sentiment is shifting, and what the true potential upside is. That's why silver, even at higher nominal prices, can still offer extraordinary returns. Its historical pattern of moving from hatred to euphoria is a cycle that repeats, and understanding that cycle can change your investment game entirely. Now, consider the lesson from speculative investment. When you buy an asset like silver at the right time, it's not enough to just hold it blindly. You must evaluate the investment thesis continually. For instance, silver was expected to rise from $20 to $50. Instead, it surged past $70. That's amazing, but it also means the original reason for holding it may no longer apply. Discipline isn't about holding forever. It's about knowing when to rotate capital for maximum effectiveness. This is where many investors fail. They get caught up in hyperbolic charts, the so-called hockey stick movements, and their emotions take over. But seasoned investors know these charts rarely move in a straight line. A rapid spike up is often followed by a correction, and a rapid drop can lead to a strong rebound. Understanding this cyclical nature is key to navigating precious metals successfully. Gold Silver Scope exists to help you see these patterns clearly. We analyze both price action and underlying fundamentals, helping you understand where value really lies. By focusing on intelligent speculation, whether through physical metals, equities, or a balanced approach, you can position yourself to benefit from the inevitable market shifts instead of reacting emotionally like most investors do. In short, the best time to invest isn't when everyone loves an asset. It's when it's hated, ignored, or misunderstood. That's where silver has historically delivered the biggest gains, and that's exactly where opportunity lies today. When silver prices climb, most people think only of the metal itself. But here's the insight many miss. The real power often lies in silver stocks. Why? because mining companies offer leveraged exposure to silver prices. If silver rises, these companies can deliver much higher gains than the metal alone, especially when their market values haven't yet caught up to the current price of silver. At one point, silver was trading at $75, and yet the best producers were still priced as if silver was $45. That means even if silver stayed flat, investors could profit from the stocks themselves. It's all about understanding the underlying value versus market perception. In simple terms, the market often undervalues companies until everyone notices. By then, the price has already run. Savvy investors spot this gap early. Diversification is key. While holding physical silver gives you safety, silver stocks can accelerate your returns. If silver rises slightly, well-run mining companies can soar because their profits grow faster than the metal price itself. But there's more to it. If silver falls, the best producers may not fall as much because their operations are efficient and their assets are still valuable. This is the type of strategic positioning that separates disciplined investors from reactive ones. Another lesson comes from patience. Many people buy silver when it's already climbing, chasing momentum. That's a mistake. The best returns often come from buying when the market hates it. Think back to silver at $20. Everyone dismissed it, but those who bought quietly then have been rewarded many times over. The key is patience, waiting for the market to realize the true value. It's also important to continually reassess your holdings. Investing isn't static. If your silver has already doubled or tripled, the original reason for holding it may no longer exist. At that point, rotating profits into other undervalued opportunities, like physical gold or overlooked sectors such as energy, can protect gains and create more opportunities. Diversifying intelligently is not just about spreading risk. It's about making your capital work harder across different scenarios. Understanding cycles is critical too. Silver often lags behind gold in early stages of a bull market, then outperforms during the peak. Experienced investors watch for these patterns. They don't panic during corrections. They recognize that volatility is part of the game and use it to their advantage, adding more when prices dip instead of following the crowd and selling out of fear. At Gold Silver Scope, we emphasize this strategy. We don't just track prices. We analyze valuation, momentum, and market psychology, helping you make informed moves. This approach also applies to mining equities. The best companies, with strong balance sheets and high-quality assets, can offer both stability and leveraged upside. Meanwhile, smaller, overlooked firms carry more risk, but also the potential for outsized gains, especially if acquired by a larger player. Finally, it's about understanding speculation versus savings. Physical gold is your savings account, safe, secure, and reliable. Silver and silver stocks are where intelligent speculation happens. By keeping this distinction clear, you can manage risk while still taking advantage of high-growth opportunities. Silver and gold don't exist in isolation. Their value is shaped by global money, debt, and economic cycles. One of the most important lessons in investing is understanding how fiat currencies, like the US dollar, lose value over time. Governments issue more money, create bigger deficits, and pile up debt. The result? The purchasing power of currency declines, making precious metals a critical store of wealth. Gold is often seen as the ultimate hedge. It preserves wealth when currencies weaken, inflation rises, or central banks inject liquidity. Silver, while similar, has an added industrial component, making it more volatile but also more dynamic. This volatility can scare some investors, but for those who understand the cycles, it's an opportunity. Silver often starts slow in a bull market, then accelerates past gold, offering higher short-term gains. Another key factor is comparing assets in terms of real value, not just nominal prices. Take copper, oil, or other commodities. they may rise in dollar terms. But if the dollar itself is losing value, the gains can be misleading. That's why experts measure these assets in gold ounces. It's the real unit of account. By doing this, you see which investments are truly gaining value and which are just keeping up with a weakening currency. At Gold Silver Scope, we emphasize understanding both macro and micro factors. Macro tells you why precious metals will outperform fiat in the long run. Micro helps you select the right companies, the right entry points, and the right allocation. Combining these insights creates a strategy that withstands volatility, instead of being driven by short-term hype or fear. Patience and discipline are essential. Many investors fail not because their ideas are wrong, but because their behavior is flawed. They chase rising prices, rely on tips, or lack conviction in their strategy. Markets are cyclical, and even the most successful investments often experience large drawdowns before delivering outsized returns. The key is staying calm and focused, buying undervalued assets, and letting time work for you. Speculation and risk management also go hand in hand. When silver or silver stocks surge, it's tempting to hold for more. But the smart move is knowing when to rotate capital, maybe into physical gold, energy sectors, or undervalued stocks. This way, you lock in gains while positioning yourself for future growth. Diversification is not just about spreading risk, it's about optimizing returns across changing conditions. Long-term strategy also involves spotting opportunities in the mining sector. High-quality companies offer stability and predictable growth. Smaller, undervalued companies carry higher risk, but may become takeover targets, creating opportunities for outsized gains. Success comes from balancing caution with calculated risk, knowing when to buy, when to hold, and when to rotate. Finally, remember this. In uncertain times, liquidity is your friend. Having capital available allows you to act when opportunities arise. Whether it's a dip in silver stocks, a correction in gold, or a new undervalued sector, being prepared to act can be the difference between ordinary returns and extraordinary gains. Investing in silver and gold isn't just about prices. It's about understanding market cycles, volatility, and human behavior. One of the most common mistakes investors make is confusing excitement with opportunity. When silver surges rapidly, many jump in blindly, driven by fear of missing out. Experienced investors, however, see these moments as signals to reassess and act rationally. Silver is highly cyclical. It often lags gold in early bull markets, but can outperform dramatically once momentum builds. Understanding these cycles is crucial. The first step is recognizing that corrections are normal, not threats. Even assets that eventually soar can experience 40–50% drawdowns along the way. For example, a junior mining stock might triple over several years, but along the journey, it may fall sharply multiple times. Being prepared for these swings separates disciplined investors from emotional ones. Volatility is not your enemy, it's an opportunity. If a high-quality silver stock drops sharply, a savvy investor sees it as a chance to buy more at a discount, not panic sell. Similarly, when silver or gold prices rise too quickly, it might be time to rotate gains into other undervalued assets, such as physical gold or strategic sectors like energy. The key is aligning your moves with both your thesis and risk tolerance, rather than chasing hype. A major part of success is knowing why you bought something in the first place. Every position in your portfolio should have a clear purpose. If silver is no longer undervalued or speculative opportunities have shifted, your strategy should shift too. This is where rotation and diversification come in. Reallocating capital to maximize long-term returns while managing risk. Another critical element is understanding the companies behind the metals. Many investors focus on prices alone, ignoring the fundamentals of mining companies, reserves, costs, production capacity, and strategic positioning. High-quality companies offer stability and consistent growth, while smaller, riskier firms can provide leverage and outsized gains, particularly if positioned as acquisition targets. Assessing these factors reduces guesswork and improves decision-making. Behavioral discipline is key. Most investors are impatient, anti-contrarian, or easily swayed by short-term noise. They buy when the market loves a stock and sell when fear sets in. Successful investors do the opposite. They buy undervalued assets when sentiment is negative and sell or rotate when the thesis is fulfilled or the market becomes euphoric. Finally, speculation requires preparation. Know your upside and downside, assess liquidity, and ensure you can weather volatility psychologically and financially. Investing isn't about being fearless. It's about being rational, disciplined, and strategic, even when the market behaves irrationally. Silver and gold offer enormous potential, but only to those who combine patience, insight, and smart risk management. Now that we've explored market cycles, volatility, and the psychology of investing, it's time to put all of this into a practical strategy. Gold and silver investing isn't about guesswork. It's about preparing, positioning, and acting at the right times. 1. Diversify within precious metals. Physical gold and silver provide stability, while mining stocks offer leveraged growth. Allocate capital based on your risk tolerance. Even if silver prices stall, quality mining equities can still rise due to undervaluation or cash flow. 2. Follow market cycles. Understand that corrections are normal and expected. Parabolic rises often lead to temporary pullbacks. Use these pullbacks to add to strong positions rather than panic sell. 3. Rotate strategically. Don't hold everything in one asset. When silver or mining stocks surge, consider rotating a portion into physical gold or undervalued sectors like energy. This locks in gains and balances your risk across the portfolio. 4. Focus on fundamentals. High-quality mining companies with strong reserves and potential for mergers and acquisitions can provide reliable growth. Riskier companies can offer high reward, but require careful research. Always know what you own and why you own it. 5. Plan for volatility. Be ready for 40–50% drawdowns in speculative positions. Those who can endure volatility often capture the largest gains. Remember, volatility is an opportunity if you stay disciplined. 6. Use gold as a unit of account. Measure other commodities or stocks in terms of gold to understand true value. This prevents being misled by rising prices in depreciating fiat currency. 7. Maintain liquidity. Always keep some capital available to act on opportunities. Having cash or physical gold ready allows you to buy undervalued assets during dips without panic. 8. Discipline and patience. Most investors fail not because their ideas are bad, but because they lack patience, act emotionally, or follow the crowd. Stick to your thesis, rotate strategically, and think long-term. At Gold Silver Scope, our goal is to give you clear, actionable insights on gold and silver. Understanding the bigger picture, cycles, and investment psychology helps you make smarter decisions, not just follow hype.